The Hedgeless Horseman here. It's October 21st, 2022. I will try to make this a short video, and the topic will simply be why, at face value, a volatile cyclical sector like the mining sector is really the easiest type of sector to beat, to outperform. And the very same reason why it's hard is also why it's so easy. Again, I've shown this graph or this chart 100 times by now, probably. This is one of the, I think, best trading sardine type companies that is out there, because it has long history, been through multiple ups and downs, and the company hasn't changed too much, at least over the last 10 years, I would say. So first of all, I mean, what is obvious is that the mining sector is very volatile and because it's cyclical. So it goes up, at least juniors. Juniors can go up several hundreds of percent, then they crash up to 90%, then they go up several hundreds of percent, then they crash several up to 90%, and rinse and repeat throughout history. I mean, this is Barron's Gold Mining Index since 1939. So survived Second World War, stagflation, I don't know how many crashes. I don't know if I would call hyperinflation, but this is, the inflation of the 70s, etc. First things first, the mining sector will be around until the end of civilization. So it never stays down. This never goes to zero, and it never continues all the way to the moon. But you can see, I mean, at every spot in this chart, the best buys are obviously, the lowest, especially in a given time frame. I mean, this was the best buy in, several years. This was the best buy until one could say this buy, even though this was obviously lower, but very high returns after that. And typically, like you see, after a real crash, once the bottom is in, it doesn't take too long of a time for it to retrace pretty much the entire movement, and sometimes go beyond it. Thing is that you never know when the bottom is in, except in hindsight. But obviously you could have a strategy that would work here, is that you start buying this sector. Let's say you start buying when it's down 50%, and you don't stop. You don't stop. You don't care about when the bottom is in. Let's say you started buying here. That's gonna, be in profit, and you buy all the way down. So maybe your average, GAV or whatever you call it. I mean, if that's here, you'll be in the money a lot here. If you start buying here, buy all the way down. Maybe your average will be here, a lot of money. Maybe you start buying here, average all the way down. Your average will be here, a lot of money. I mean, the point is that like the simplest thing to do in a cyclical sector is to just buy and pray that it goes down even more and that you have even more money, and just buy and buy and buy until the bottom is in. And on that note, this is again Bear Creek Mining. I put a blue line here. And I have measured the returns from this blue line to this level, which it has touched ever since 2005. It has touched this at every sentiment high. And this was the 2016 sentiment high, this was 2020 sentiment high, this was, I don't know what happened here, but this was, excuse me, epic 2011 high. This was a high prior to the great financial crisis. But if we just assume that this represents the junior sector and not just Bear Creek Mining, excuse me, And we know that this sector always comes back, always comes back. One could say that we know that it's gonna hit this level again, or maybe a bit lower if you account for dilution, whatever. Point is that this chart here, stretching like, I don't know, how long is that, like 16 years or something. If you bought at this blue line, at any point in time pretty much, throughout this 16-year period, you would, within say 2 years, be up 100%. Within 2 years, a double. The stock market averages 8% per year over the long term. Well, I guess here it didn't, it took longer, 2016. So here it was up to 4 years actually. But on average, 2 years. I mean, here, for example, if you bought, any of these, that was much quicker than 2 years. If you bought this, quicker than 2 years, or was it 2000? Yeah, quicker than 2 years. So, but let's just say on average, 2 years up to 4 years. What does that mean? That for the last 16 years, if you bought at the blue line, you would have automatically had a very good return if you sold at, this level. Buying here always netted you a double within, on average, 2 years. Handedly beating the stock market returns, obviously. I mean, if you could compound, if you can double your portfolio every 2 years, that's better than what Warren Buffett has done. Superb, absolutely superb results. And again, that's buying from the blue line. Now we're down here. Anytime, if it starts at 100, you can see, because again, assuming, let's pretend that this is the junior sector, so we know that it will go back to this level, because this sector is forever cyclical. After this, you double if you start buying at the blue line. It's just a matter of how much better your buys are, because the blue line is a good buy. A double within 2 years, that's a great return, superb return actually. Then it's just a matter of degrees how good buys you can get. So I mean, think about it. It's like, now for example, I mean, there are two options. If miners never turn around, you lose all your money that you have invested right now in miners. If miners ever turn around, you'll make a ton of money even with dilution. The former has never happened. And you can see how far below we are the blue line. So I mean, if history is a guide, this buy here will be profitable within 2, maybe 3, let's say max 4 years. And that would 3 years and 100%, that's like Warren Buffett's type returns. So if this, judging by history, is a good buy, what do you think this is? I mean, this is, again, it's like everybody right now focusing on downside risk. You can just pull up a chart, historic chart, for any cyclical sector. And you can see that there's a rally after every crash. And the best buys are the lowest. It's not that this was a bad buy because it hit here. No, this is probably going to be a very profitable buy. It's just that these buys will just get better. And that's why it's so funny. People, they sell here, and then they see this happen, and then they feel good about themselves. Oh, I was smart. I suffered. I dodged a downtrend. In my opinion, that's just stupid greed. I mean, what if you sold here, for example, because you thought it would go lower, and then it went higher, and maybe you didn't buy? Who knows? Maybe you bought back in here because now you're pretty sure that it's a uptrend again. mean, your returns would have been 48 if you actually, sold close to the top. That's the thing. It's like market timers. There's no price low enough for them. Just buy. Even though, again, if you just look at this chart, every buy at the blue line turned out to be a great buy. But every time people will, especially if they try the market time, like, no, I know it's extremely cheap, I'm not going to buy, and then it heads lower, and then they're like, it reinforces them the belief that, yes, market timing is good, and I dodged, a 30% retracement or something. But the thing is that if that's the case, you wouldn't have bought this bottom, you wouldn't have bought this bottom, etc. Because you're always going to expect that it's going to go lower. So once in a while you're right. And I mean, this rip here for 100% return, I thought that was the bottom. It wasn't the bottom. But imagine I sold here because I was going to start market time. And I thought, I'm pretty sure it's going to go lower. I know this is, it's cheap already, but I think it's going to go lower. So I'm going to be smart. Quote, smart. It dips and you sit there like, yeah, I know I'm the best. Then it rips 100% and you're like, oh, geez, okay, now actually the bottom is in. So now, the coast is clear. So you buy in here. Then it drops again. I mean, compare that to the person who would just have bought all the way down. He would have lowered his average. So maybe his average was, down here, for example. Whereas this market timer, his average is now up here. And you go back to this spot. This guy would have neutral returns over this period. This guy would already be, I don't know, shaved off 40% of his position in like a month, let's say. Or 2 months. How is that good? I mean, in my opinion, that's just to market time around, especially these extreme levels. I mean, that is just super greedy. History, there's no example, especially in Bear Creek mining, of that ever being a rational thing to do. Because every buy around, these levels have turned out to return multiples on your investment. So what you literally are saying, if you sold here, for example, you're saying pretty much that I'm going to give away a pretty short 200% return because I think I can get 300%. That's greed, and typically the people I think do that are the ones who don't even end up beating the market anyway. That's the funny part. Again, it's like, if you just looked at this chart, it would be so easy if you knew that's like, yep, we say this is representing the junior sector. Any buy at the blue level is going to be a very profitable buy. And now we're down here. I mean, it's just degrees of how extremely good the buys are. That's what I, already months ago said that, we're past, in my opinion, we're past the point of selling. Because now it's just a matter of how good the buys are. I'm not going to complain if my portfolio would average like 100% from this point here, for example, in 2 years. And I could just keep doing that. And let's say I actually have, can sell these trading sardines when they hit, let's say, this level. So every time it hits this level, I know, okay, I'm at least going to double my money. And the lower it goes, the bigger the returns are. So it's like, by default, that means that, again, assuming history will repeat. I don't know if Bear Creek mining will be around, but the entire junior sector is not going away. So it's just a matter of it's like, okay, if you bought here, you'll get 100% on return on that buy in say 2-3 years. Down here, you might get 200%. 300%, 400%, 500%, etc. I mean, every buy would be good. It's just degrees of how good. And you don't need to have, be all in at the bottom every time. I mean, if you're down 50% right now, I mean, personally, I don't see that as a problem at all. This is the fourth time I've seen, my average junior down, let's say 50% from the recent top. But the thing is that a lot of people, and I know that I've spoken to a few, I mean, they got in here literally like close to the top. And that's unfortunate, of course. But that does, again, not get rectified. You're just making an even worse mistake by selling down here. And I think, trying to market time, then you don't really understand, opportunity. If you're trying to market time around these levels. And I know there's a bunch of people who are completely out of the mining sector right now. And for the life of me, I can't figure it out. And typically, I mean, they feel really smart if they sold here, for example. Or here. They feel really smart right now. And I can almost guarantee that I will beat all of those market timers over the longer term. Simply because I don't even try to market time. Not really. I let the opportunities come to me. But on that note, one thing is like, here you have a growth company, let's call that alpha, creating value. So even though sentiment gets depressed, I mean, if let's say ounces in the ground get revalued by 200% going into a sentiment high, then the ounces in the ground gets, valued at, I don't know, 1/4, let's say, down 75%. But they have added ounces over this time, so even though the valuation you get for ounces in the ground is down 75%, they have added ounces, so it only goes down 50%. So that's basically, I mean, that's what I like. I mean, I talk about hodl cases, long pipelines for growth, good management, good access to capital, let's say, Snowline right now, Western Alaska, Goliath, and stuff like that. I mean, the ones that if you give them 1-2 years, they might have doubled the gold on their books. So even if gold in the ground is valued less, let's say half, but if they have doubled their ounces in the ground, excluding dilution, you would have been flatlined. It's like you see in Eloro Resources, for example. Added so much that even if sentiment turns against you and the ounces in the ground get valued less, they have, added so many ounces that it's actually just neutral. That's great. But the thing is that, like you've seen beta plays, they crash like 80-90%, then they go up, 400-500%. Crash like 70% up, 300-400%. Crash 80-90%, I don't know, up 500%, let's say. So the thing is that alpha is more of an all-weather approach, which I really like. I mean, you can see there's a few really good explorers that are either even or up since the top in 2020, and if you go back, a bit further, they might still be up a few 100% over the last, like, let's say 2-3 years. That's a great return. You're gonna have a great long-term results if you just stick with the tier 1 growth stories, for example, because of what I just mentioned. Because they're adding quality ounces, so even if you go into a sentiment low, they will have more ounces. So even the ounces, if they're valued less, the company valuation will typically be higher. But at the same time, knowing that what happens to beta plays and how cyclical this sector is. So let's say, because again, opportunities change all the time, and that's what I talk about, portfolio reshuffling. You can take advantage of the volatility in this sector, not only, via stuff like this, but I mean, at the highs, for example, I've been mostly in alpha plays. I mean, bulk of my portfolio has been in alpha plays for the last 2 years, I would say. But where we are right now, one could say is akin to something like this, that the beta optionality developers, advanced explorers, they have crashed so much that you could, if you wanted to, diversify a bit. Because if we go into another uptrend, given how much or how low some of these optionality plays goes, etc., without even finding more ounces, they can go up like 400%. Whereas, perhaps some of the alpha plays, they might go up, to 300, let's say. So I guess my point is that you don't want to be in beta at the end or at a sentiment high, because they're not going to create value. So there's nothing there fundamentally that's going to buffer the retracement. If the company has 4 million ounces on the books here and 4 million ounces on the books here, hasn't added any ounces really, and excuse me, and the ounces in the ground are valued at $80 per ounce at the sentiment high, and then they go down to $20 per ounce. That's a 75 haircut and no additional ounces. But at this point in time, when ounces in the ground are least valued by Mr. Market, which is absolutely brain dead right now, that opens up for the time to shine for the beta plays. So, letting the opportunities come to us. Let's say the really good alpha plays, they might have retraced down here, but now we're down here for the beta plays. So they're like semi-low risk upside is at the highest it's been since 2015-16, for example. If there was ever a time, and I spoke about that on K Report recently, if there was ever a time to start thinking about, hopefully or preferably cashed up advanced explorers, or even I'm dabbling in some micro cappers that actually are low on cash and all of that, but I just enjoy the idea. Like I've said some time before, I want to be the guy that is able to buy the lowest. That is cool to me. Profits are cool, etc., but to be able to buy when no one else is, that's hugely profitable. Why does it suck right now? Each additional day down is like exponentially worse. Going from here to there, that's like, let's say a 20% drop from here to there is like, whatever. It's like you're probably, even if you got in late and got in here, you're still in the money at least. But a 20% drop from here to here or here to here, that is something very, 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 very few. 1 in 100 people can stomach that and just keep buying. 1 in 100 people can keep this in mind, that every crash is followed by a big rally. And the lower you buy, the more money you make. The lower you buy, the more money you make. But the pain is going exponential right now. So people forget the common sense about this ping pong type of market. So they think I can't lose more on paper. So I'm going to start market time. I'm going to get in when the coast is clear. Biggest mistake you can make, in my opinion. Because like I said, if there's anything you take away from this sector is just how easy it is to beat if you have infinite patience and common sense. Like I showed here. If you bought at this level, this blue line here, for the last 16 years in Bear Creek, you would get a doubling of your buy. Your buy would return 100% within 2 years on average. A doubling every 2 years from the blue line. If the price is lower, you're gonna get more than a double within, on average, 2 years. So think about it. If you think about it like that, how hard is this sector really? If this was a never-ending bull trend like in the broader stock market since 2008-9, that would look really good on paper. Really good on paper. But if the miners just chugged along, a bit higher on average every month, every year, there would be no obvious opportunities for really, really outsized returns. You would actually have to be a really good stock picker. Because even if it went up 8% per year, for example, I mean, in this sector, a volatile sector like this, you can get 500% within 2 years. You never get that in the stock market. So the very thing that makes this market hard for people is volatility. Because not a lot of people can stomach paper losses and keep on buying, knowing that they will eventually look very smart. The longer you buy and look wrong, the harder it is. But I mean, you don't even really need big time due diligence in this sector. But if you wanted to beat an ever upward trending market, steady pace kind of thing, like 8% per year. If you're gonna get more than 8% per year, you'll have to be really good at stock picking. Find the stories that, the few that are undervalued, unseen, unknown, that can return more than 8% per year. In this sector, just from the volatility alone, I mean, right now, for example, you can literally, I think, throw darts. And if you wait 2-3 years, I think you're on average going to be up several hundreds of percent. You don't see that in the actual regular stock market. So I personally love this sector. The very fact that we are here is a testament to how easy this sector actually is to beat. If the volatility would be like this instead, there would be no huge opportunities. There would be no huge discounts. The market would be so rational, or close to rational, that nobody would have been doing something really stupid like buying very high or selling very low. But thankfully, this is an extremely volatile market and an extremely emotional market. And the only thing you really need to beat this handedly over time is infinite patience and common sense. If this was a good buy, this is a greater buy, even greater buy, even greater buy, even greater buy, even greater buy. So it's just a matter of when it's gonna turn. And I think all of these buys, I mean, not saying again Bear Creek directly, but for the junior sector overall, I think all of these buys are gonna show a profit one day in your average junior stock. I think right now, your average junior is going to return an incredible amount. If they go lower, that will still be a great buy, but this will be an even greater buy, and this will be an even greater buy, because when it finally turns, when we hit a new sentiment high, all of these buys are going to be in the green. So again, if you went all in here, judging by history, you would double your portfolio. The only way to get an even better return on your portfolio is that price actually went down and you just kept on buying the lower it goes. And one last thing about market timing. This is the GDX. I just drew this. I mean, this sector is typically very choppy, etc. And again, it's like, if you're gonna trade or whatever, I mean, to just love crashes, that is the best edge you can have. That's the easiest way to beat this market. You don't even need brains, really. You just need to know that every crash will stop one day. And since 1939, it has been hugely profitable to buy every crash. And even if you're, quote, early, if you start buying here and it just keeps going down, the best thing you could do is just add more and more and more. Just more and more and more. So, I mean, that makes this sector quite easy to beat, in my opinion. So again, translated to this chart, it's like, if you knew that this was a good buy and you know that there's just degrees of better buys, I don't think I could lose in this sector over the long term. Because again, this is so volatile that if you just have infinite patience and common sense, and don't pick the near bankrupt companies only at these bottoms, etc., I don't see how we could lose. History has shown that it's you pretty much, I'm not going to say 100%, but you pretty much can't lose just buying every crash. This was the best buy ever, best buy ever, best buy in many years, best buy in a few years, probably best buy since 2016. If we go even lower, that's going to be even better buys. So if you have any dry powder coming, it's just gonna you would actually want this to go even lower. You would want the juniors to go even lower, even though you'll have a bigger paper loss in the short term. Because I mean, think about it. If you had if you went in with 10,000 here, let's say you follow this down to let's say it's a 90% loss, and you put in 1,000 more here, so you're down 9,000, but you double down and actually double your portfolio from like this level here, and we go into this. So that extra 1,000 buy would turn into $8,265 plus the 1,000 the 1,000 you have left after investing 10,000 here would go back to 10,000. So even if you started going all in here at the worst possible time, worst timing ever, if you put in 1/10 of what you put in here, if history is a guide, you would make 72%. And even if that takes 2 years, that would be a great return. I mean, what's this? 2020. Let's say 4 years. 72%. That's good. That's better than the overall market. It's not, I mean, super great, but of course, who are you gonna get beaten by? The ones who buy even more at these levels. The ones that, well, first of all, hopefully didn't go all in here, but they just kept on buying. Lowering their average, lowering their average, lowering their average. Maybe their average went down to this level. So I mean, not that they went all in at the bottom, but still, they would have a 323% return on their entire portfolio at the next sentiment high in that case. Superb, absolutely superb results. And yeah, again, the point of this was like, I mean, since you never know when you're gonna try to market time. I mean, if it went something like this again, let's say you try to be a market timer, waiting for the coast to be clear, you buy here, and it actually retraces down there, etc. I mean, you bought in here, now you're at a loss. What are you gonna do then? Let's say it goes higher a bit, or that you like, okay, you buy here. You see this and like, yeah, we're going to, back to the highs, etc., and it doesn't work out, and you're gonna, in that case, you're probably gonna say, yeah, next time it goes back to this level, because this sector never turns around, so I'm gonna sell next time it hits there. So you just sit pat, for example, but then it goes back here and you're like, oh, a lower low, screw this, but maybe you hold out, and then we go to this level, and you've seen two, like, two small rallies, and you think that, this sector always turns down, next time I'm going to remember to take profits. So you actually take profits here, and then that is the actual real move. I mean, I don't care about anything like that. I don't want to do anything like that. I just buy extremely cheap, and that's the thing which I've said before. The reason I can afford to have such huge drawdowns is that I was 100% invested from this level to the top. 100%. No market timing, no, getting in here with, a small position and going out here close to the top or getting out here after I saw a lower low. No, I'm 100% long from this entire move down, from the bottom tick to the top tick. Then it's up to us to actually try to pick some stocks, because again, if I was a better, top time or whatever, then I would, you could literally have just traded Bear Creek Mining. My point is that buying extremely cheap is your best offense and defense, and throughout the last 16 years, if you just any buy at the blue level would have been a great buy, and then there's just anything, if you were able to buy anything below that just means even better returns. Again, in the short term, that means possibly heavier losses. But if you let this play out, it translates to better returns, because again, you can buy here, sell out here, you're taking a paper loss. So it's up to our decisions. I mean, that's why this is the around these levels, that's when mistakes are the costliest, because a mistake in this case would be selling, in my opinion. Extremely costly. If it goes down here, to sell here would be even costlier. And on the flip side, buys just become better and better. So when you really think about it, this sector is extremely easy to beat if you just have infinite patience, common sense. You don't even need to be a good market timer. I don't even think you need to be a big stock picker. You just literally need to buy the crashes. Every time the sector crashes, you just need to be piling in. Be smart about it, obviously. Not pick the worst companies, etc. But other than that, there's two options. The miners will never turn around, or the miners will turn around. And the former has never happened. So if we're gonna lose from these valuation levels, that means the sector must never turn around, or not within the next, 4 years or something, or until every company goes bankrupt, which has never happened. So again, I think I spoke to a guy. He basically printed out this and just put it on the wall. I think that's a great idea. The market is not some supercomputer, hyper rational. This sector especially is just a big greed and fear monster, and you can't take this market seriously, because nothing is rational about this sector right now. So you probably get paranoid thinking about it, like it can't be this easy. Actually, it is this easy. It's just that it's very hard to do in practice. Because most people sit and think what they think a stock is going to do today or tomorrow. That's the time horizon people have. How many do you know I have in this day and age? Infinite patience and common sense. Patience has probably never been lower in the history of mankind. Common sense, given the policies we see out there, or thanks to the median voter, I would say there's not a lot of common sense around either. But you have to have both, common sense and patience. If you have common sense but not the patience to play this out, you won't make it. If you don't have the patience and common sense, well, maybe I repeat myself, but you know what I mean. You need both. You need to be able to wait until this sector turns around. And it always turns around. Always. Has always turned around. The most profitable buys have always been during the biggest crashes, the absolute lowest point of a crash. So where we don't know where the actual lowest point is, we just know that any additional down day is getting us closer to the bottom of the crash. So again, one day forward, price a bit lower, closer to the final bottom. And the final bottom, which we won't know when it actually is, will be the best buy in 8 years or something like that. Yeah, I mean, again, you do whatever you want. I know there's people who don't agree with me. This has worked out very well for me, and history suggests that this is going to work probably forever. And if you're not comfortable and you want to trade or do something like that, do that. This is, in my opinion, the most no-brainer and most profitable way to beat this sector. But again, quote, not investing advice. Thanks for listening. Bye.